The Malaysian bank entering new market must be prepared to confront the three global risks, which is political risk, economic risk, and cultural risk. Political risk refer to the possibility of political turmoil or intervention that might disrupt a country's business activity. Economic risks occur when a company operations inside a country are adversely affected by the economic condition and laws, currency exchange rate, and property rights protection of the nation. Cultural risk is the possibility that the company activity in a foreign country might be hidden by cultural differences, such as a different language, cultural norms, and consumer preference. Political risk. Most businessmen are naturally hesitant to invest in nations which are inherently insecure like Afghanistan and Somalia. Businesses may focus their effort on countries with lower political risk such as Japan, South Korea, Canada, and Australia. Albeit opportunities are often restricted in these settings. India has a low until moderate political risk. The ongoing Kashmir conflict between India and Pakistan pose a constant military danger, while long-standing border conflicts with China have recently worsened as well. If this conflict goes more severe, they might have a negative impact on the economic recovery and weaken company confidence. Economic risks pose significant difficulty to CEOs since economies are inherently unpredictable. International business executives must take into account a wide range of variables and attempt to forecast how they could affect their organizations. The COVID-19 outbreak sparked a lengthy and stringent statewide lockdown in India, resulting in the country's greatest economic collapse ever. The informal sector and small businesses, where 90% of Indian workers are employed, were disproportionately impacted. The cultural risks that must be considered while dealing with Indians in a professional context. First of all, Indian country has a strong sense of social hierarchy. Hierarchy plays a major role in Indian society, affecting everything from behavior to decision making. Second, there's the yes mentality to consider. When communication, Indians attempt to be agreeable. As a consequence, they have a propensity to say what they believe will satisfy someone even if it contradicts with the facts. In addition, losing face is a major taboo in Indian culture. Therefore, individual will answer yes in an effort to perceive face. Challenges before penetrating. Foreign banks that wish to begin operation in India must face a number of unique and difficult challenges. The risk associated with the founding and operation of a bank is much greater than that of any other business type. Regulatory issue. International and local banks that wish to operate in India must meet the stringent requirements established by the Reserve Bank of India (RBI). RBI does not support business concepts that disregard the goal of financial inclusive. International banks wishing to join India in order to provide specialized banking services are required to apply for a universal banking license, which maintains the launch of full-fledged banking services in India. Therefore, promoting financial inclusive could not apply to all international banks joining the banking industry. Longer gestation period. Typically, RBI has been stringy with banking license. The previous private banking license was issued in 2003, then again in 2014, and most recently in 2019. Due to the complexity involved, it is far more difficult for international banks to get license. In addition to administrative concerns, licenses are granted to international banks depending on the basic ties between India and the country of origin of the international bank, as well as equitable agreement between the banking regulator of the two countries. This caused a significant delay between the license application and its eventual issuance. Furthermore, there are challenges for international banks after penetrating the marketplace. First, the dynamic environment in India. Foreign banks seeking to join India will face stiff competition from established businesses with a large number of branches and a large client base. Currently, international banks are prohibited from establishing operations in India Tier 3 until Tier 6 cities, but the RBI's new rules might eliminate this restriction. International banks will be able to take advantages of this since the established businesses do not have a strong presence in this region. Second challenge will be the unique product mix in the Indian banking business. For the most part, Indian banks' offerings are geared at the retail banking sector. Retail clients are a major source of low-cost capital and fee revenue for the majority of banks in India and across the world. Where retail customers fall short in terms of value, bankers make up for it in terms of quantity. As a result, product development is focused on these clients as well.